Ashwini wants to know what parameters should be looked into for selecting fund schemes by a first time investor.
Uh, More importantly, you should. Uh, the first step is, as I was telling in the initial part of this hangout session, that you should be clearly able to divide whether you are, what is the time frame of your investment. If you are investing to realize that money in 2 3 years time for a goal, then it has to be necessarily fixed income. And if it is for a non-negotiable goal, then it has to be only fixed income. If it is a little negotiable goal that you are saving or you are investing for a little negotiable goal like down payment of a house which can be done in a period of 3 to 5 years, then you can mix little bit of equity, something like MIP, which generally has 10-15. So which kind of fund to invest, that entirely depends on your orientation or your needs. Once you have done that, then uh, two three things to follow. One is the fund should be, you should eliminate the consistent underperformers on a risk adjusted scale. So our rating will be helpful. uh, limit your selection to 5 star, 4 star, and even some 3 star rated fund. Drop the 1 star and 2 star rated fund. I think using value research rating as an elimination factor will be useful. So you end up with a handful of funds. Also, dropping a lot of categories. There are many kind of funds, but most investors need only 3 4 kind of funds. When it comes to equity, I would say that first time investor requires a balanced fund. A tax saver needs a tax saving fund. Or most investors who don't, who have been used to the market, they need a multi cap fund. And I think these three kind of funds meet most of your goals. If you are investing for few days or few months or few weeks, consider a liquid fund. And if you are investing for 2 to 3 years for a non-negotiable goal, or you are very risk averse and you don't want to take chances, then maybe an income fund. These five kind of funds can actually fulfill most of your needs. And keep it simple. Choose the appropriate kind. Drop the poorly performing fund. Don't get And one more important thing is, don't get attracted by the recent past performance. Most of the time investors go wrong because they choose a fund which did very well over the last 6 months or one year, and they try and catch that momentum, and they are generally disappointed.